I came here 7 years ago, Jeff Stinson is one of the first people that I heard about, and I understand why he is a godfather of the Arkansas entrepreneurial ecosystem and never brags about it. But you may hear a lot, know that he runs Health Tech Arkansas, which has an accelerator program and runs innovation programs. But he was one of the very first people to be talking about the importance of entrepreneurship in this state, led the formation of the first angel investment funds, led the formation of the first very idea stage business incubator for people who didn't have any resources at that time, and has mentored me every step of my journey since I've been here for the past 7 years. And I just love collaborating with him. So he could call me and he'd be like, hey, do you have any interest in doing like a cryptocurrency cruise with Disney and some entrepreneurs next week in the South Atlantic? And I would say, yeah, are you going to be there? And if so, yes. So Jeff, thank you so much for being here. I'm looking forward to your talk.
Thank you, Sarah. No chance anybody lives up to that kind of introduction. I can only fall from here based on that. But thanks, everyone. I'm Jeff Stinson. I have been doing this quite a while. I'm actually quite old. I'm older than I look. I turned 57 in a few months. So I've been around the early stage ecosystem in Arkansas for 24, 25 years doing this. And so I've learned a few things along the way. And when I'm in a room of like really smart, accomplished people like this, I kind of have to remind myself that there might be a few things that I know that you don't know. And that helps me from not being so intimidated by being in a room like this. So I'll try to share those few things that I might know with you. But before I do that, I wanted to say a word about Kevin Sexton. So a few years ago, when the opportunity came up for BioVentures, I was pleasantly surprised that Kevin threw his name in the hat for this, because he's got a lot going on and he could be doing a lot of things other than being an administrator of a tech transfer office at a university. And in fact, he was doing all of those things. And for whatever reason, he decided he wanted to take this on as a challenge. When he did that, I reached out to UAMS administration and I said, I am reminded of a saying that an old boss told me, which was, if you have a cannon, shoot it. And I said, what you have with Kevin is a cannon, and you guys need to resource him the right way and support him and let him make BioVentures all it can be. And I'm so glad to see that they've done that, because he's building a great team at BioVentures. So I'm really happy about the direction. So having said all that, let's think about what we're going to talk about today. So 3 sources of capital. Before we talk about that, I want to just kind of set the overall context of when you have an innovation that comes out of research from any research university or health system like UAMS. If you think about, there's really only 2 paths to get that thing to market. And that is, and some of the speakers have talked about this today, but that innovation will either be licensed to a startup company that's formed to take that innovation to market, or it's licensed to an existing company in industry. And that existing company in industry will sign a license agreement with UAMS, and they will make the thing, take it to market, and pay royalties back to US. But those are really the only 2 paths to get new innovations to market, right? It's either a startup has to do it or an existing company has to do it. So there's an industry for the tech transfer industry. There's a trade organization called AUTM. It's the Association of University Technology Managers. AUTM will tell you that each year it's pretty consistent that around 88 to 89% of all license agreements are signed with industry. So most faculty researchers and health system researchers, when they commercialize their inventions, the vast majority of them go to existing companies in industry. About 11 or 12% of those innovations are licensed to startups. And you as an inventor can either choose to be a part of that startup or not. It's kind of cool if you do want to be part of a startup, because I think there's particular rewards that come out of that. But just know that most innovations go to existing companies and industry. And if you do that, you really don't have to worry about this. This is really the funding piece of it that really speaks to startups, right? So if your innovation goes to a startup company that you're a part of or not, then we're going to talk about how things get funded. So you think about a technology-based startup that comes out of spins out of BioVentures, for example. For that startup company, why is debt generally not a preferred option or even a viable option for that startup company? Why do tech startups generally not just go get a loan from a bank to fund their operations? Any thoughts on that? Have to pay it back. That's an obligation. Exactly. There's no tangible asset to collateralize the loan. So to get a loan, it has to be secured with something. So if a researcher or a startup company founder has to secure that loan with personal assets, then what's really the point, right? You might as well just fund the thing yourself. So for debt, for the most part, we can eliminate that as a category for tech startups. Grants, you just heard in the last session about all the different forms of grant. Grants are obviously the perfect form of capital because you don't have to pay them back like a loan, and they don't dilute your company, the ownership of your company, like equity investments would, right? So to the degree you can get grants, that's an awesome, amazing thing. So Sarah's brother has a company that is the whole principle, the basis of it is taking university-based research, pulling those things into startup companies, and he identifies innovations that lend themselves to SBIR and STTR funding because that's such a powerful funding mechanism. He knows that when he starts companies around that, he's going to get a chunk of money up front that is not dilutive to the ownership of his company at all. He doesn't have to pay that back. So it's far and away the best source of capital. So what we're going to talk about is equity, because at some point, startups need to raise outside equity capital. And equity is just exchange of an ownership percentage of your company in exchange for investment dollars. So that's what equity is. It's ownership in your company. So here is the equity capital spectrum. So, when companies get started and they run out of grant funding, or they realize they need other smart people along the way to help them as part of their thing, then they will reach out and start to raise external capital. So that first 25,000, which is not a hard and fast number, it could be the first 50 or the first 10 or whatever it is. But generally, tech-based startups will just get friends and family and founder money, or as some people call it, friends, family, and fools, right? Because that is the highest risk, earliest capital that goes into a company. Then traditionally there has been what they call the valley of death, where you bridge over to where you can start to get $100,000 or $200,000, et cetera, from angel investment groups. People work really hard to try to bridge this valley of death. The state of Arkansas has the Technology Validation Fund, our Technology Development Fund that is now in place that will provide $100,000 for companies. Dr. McManus has received that. So that's a really good program. I think the U of A now has a gap funding program to help bridge that gap. So there's a number of sources of that, but it's a really hard gap when you run out of your own money and you're trying to get angel investors on board. So angel investors, and we'll talk about sort of what that terminology means, but then they come in and they're investing 100 to 200,000 and up. And then you get over to venture capital firms where they are investing, generally $1.5 million, $2 million, $3 million, et cetera, on up in your company. And you just keep going along that spectrum. In theory, the value of your startup rises as you raise more money, and you're raising it from different sources, but the value of your company just goes up. So, if you raised $100,000 in the very early stage, you're going to give up a bigger chunk of your company because it's worth less than if you raised $100,000 10 years from now when your company's worth a whole lot more, right? So your company is valued at each stage along the way. VC firms probably 25 years or so ago were investing in startups, and venture capital firms just don't do that anymore. And in fact, you see the evolution of angel investment firms. They are also evolving away from pre-revenue startups, meaning I'm going to invest in a startup company even before it has revenue in the marketplace. And it's because people avoid risk, right? So as that model evolves and people get pushed out along that spectrum, it just opens up that gap, that valley of death, even wider. All right, so angel investing. So angel investing is a high net worth individual who invests money in startups. That's all that means. I think the term probably came about because if you have a tech startup and somebody's willing to write a check into your company, they probably seem like an angel, right? And but the term has been around a long time. It has its own trade association. It's called the Angel Capital Association. They have probably 250 or so member organizations around the country. So those angels can be individuals, syndicates, or funds. So a syndicate would be, which we have two in the state of Arkansas. We'll talk about that. Syndicates are basically just a group of angel investors. They all get together. They look at deals together. They review them together. But then each individual person makes his or her own decision about the companies they want to invest in. The fund model is different. A fund is we're all going to get together and we're going to put money into a fund. And then the fund is the single investor in those companies. So it can be structured lots of different ways. Various levels of funding, both funding and due diligence conducted. So I ran the state's very first angel investment fund. So how many of you have heard of Dr. Mary Good? Does that name ring a bell for some of you? That's good. That's excellent. So Dr. Good hired me twice in life. She is just a titan of lots of things, but including in that, she is generally considered to be the founder of early stage investing in the state of Arkansas. In 2001, she was hired. She was actually, I think, the first female PhD in the state of Arkansas. And she passed away a few years ago at 89 years old, something like that. Anyway, in 2001 was the first time she hired me, and she had been pulled out of retirement by UA Little Rock to become the founding dean of the College of Engineering. At the time, she had just 2 years before that, she had founded this local investing club in Little Rock, and it was called Venture Capital Investors, which was a misnomer because it wasn't really a venture capital firm. It was just an investing club. It was about 20 rich people in Little Rock, and they all got together and they invested in deals. They invested in Safe Foods, which was their very first deal that they all looked at together that actually came out of BioVentures. So they did that for a couple of years. Dr. Good went to become the founding dean of the College of Engineering, and she hired me to backfill her role in administering that little investment club. We worked with that for a few years. Then we launched Fund for Arkansas's Future, where we turned it into a fund model. We went around the state, asked as many people as we could to put money into that fund. We ended up with 57 investors and about $6.6 million. We invested in 18 tech startups, launched a second fund after that. So for 15 years, I managed Fund for Arkansas's Future, and it was a great, fantastic gig. I mean, it literally put me sort of in the center of the entrepreneurial ecosystem, and I met lots of really influential people in the state who were our investors, and that was pivotal for my career development for sure. But having all said that, people ask, how much due diligence does an angel investor do? And it really depends on the organization of that angel group, right? So if that angel is your rich aunt, she's probably not going to do a ton of due diligence, right? She's going to write you a check and she's going to wish you well, and she's supporting you. If you go to a very structured, well-capitalized angel fund who's investing on behalf of their members and they have a responsibility to make good investment decisions, they're going to do more due diligence on you. They're still probably doing less than a venture capital fund. A venture capital fund will really put you through the ringer and do 3 months of really intensive thing and know more about you than your wife or husband knows about you at the end of that process. So it really does depend on the type of investors that go through this. People often ask, what kind of returns can angel investors get? So the Angel Capital Association did a study, and in fact, they continue to do studies on this. Over the past 25 years, early stage investment funds within the Angel Capital Association have hit a 34% internal rate of return. But it's kind of misleading to think about that, because that return profile doesn't mean if you invest in 10 companies, they're all going to return somewhere between 20 and 40%. It doesn't work that way. So early stage investing is a high risk proposition. If you have a portfolio of 10 companies, then what the Angel Capital Association will tell you is that 5 of those go out of business completely. So half your portfolio is just gone. You get nothing back from them. 2 or 3 out of that 10 will have some modest return. So your money back or 2 times your money back or some modest return on that, right? But 1 or 2 out of that portfolio of 10 will go gangbusters. And that home run or home runs that you get out of your portfolio, that provides the bulk of the returns for the entire portfolio. And it just happens to average out to be 34%. But it's really like 0, 0, 0, 0, 1,000, and that averages to be 34%. So again, it's a high risk proposition. What do people look for from an angel investment perspective? So these are the things that we think that over 15 years at Fund for Arkansas's Future, these were the things we looked at is what has the ability to grow rapidly. And tech startups, for the most part, have that because, you look for things that can scale, that have unique science behind them, et cetera. So people who would approach us to invest in a hair salon or a bowling alley in Dumas or, those kind of things, those can be good entrepreneurial endeavors and they can make a good business for people, but it's not the kind of thing that can scale to be 5 million in revenue or 10 million in revenue, et cetera. And it's only those things that can scale to grow up to be that level of a company. That's the only way we make money, right? Because if we invest in a hair salon, so how do we get our money back out of that, right? The owner of that salon starts cutting hair, they hire some people, but practically that business is not going to be acquired for lots of money. The way we make money as early stage investors is if I invest $100,000 in your company when it's valued at $1 million, which means that I just now have 10% of your company because the whole thing's valued at $1 million. I contributed $100,000 of that value, so I own 10%, and we can grow your company to where it goes from $1 million in value to 25 million. Right now, my 10% ownership is worth $2.5 million. So if Google acquires you for $25 million, you're gonna make 90% of that. And so you've done really well, right? But I, as an investor, have taken my $100,000 investment and I've made $2.5 million. That's a 25x return. That's the way venture capitalists make money. So we can only make money when the companies we invest in can grow rapidly and can scale like that. Proprietary technology or industry expertise, something that gives you an advantage, scalability, and A+ management team. Startups, a lot of time, all you really have is the people. I mean, you can evaluate the technology, but if the technology is patented and it has a clear place in the marketplace, what it really comes down to are the people behind it, can they execute? So that has to be there as well. Preparing yourself for angel dollars. So these are the things we talk to people about. If you go out and raise money from angel investors, this is what you want. And it starts with relationship building, right? It doesn't start with, hey, it's nice to meet you, here's my ask. It's a process, right, of building those relationships over time, taking out technology risk. So if you think about an angel investor and where they invest in companies that are just starting up, there's a whole lot of execution risk, right? So we don't know if when we take this new innovation to market, whether the market will accept it on the terms that we think. We've planned out our business model. If you follow Sarah's approach for customer discovery and you have done building in what customers think and want, you can de-risk that part of it, but there's still a lot of execution risk. So what angel investors don't want to take is the technology risk, whether the thing will even work to begin with. So you have to de-risk the technology to be able, for the most part, to get angel investment. Recruiting a co-founder or some version of a complementary team if you don't have one. If you're a scientist, that means recruiting a business person. If it's a business person who wants to launch a software app, that generally means finding a technical co-founder, someone who can code and develop things like that. So building a complementary team, eating and breathing your technology, markets, competition, and your sustainable competitive advantage, it takes a lot of commitment to make a startup work. Most of them fail. So the ones that make it really, it comes down to the tenacity of the founding team, and can we really go after this every single day and make it a priority for us. And then lastly, I would say integrating yourself into the Arkansas entrepreneurial ecosystem. It is very rare for companies who are not part of that ecosystem, who don't know the entrepreneurial support organizations like Startup Junkie and the Conductor and the Venture Center here in Little Rock and Health Tech Arkansas. For companies who come outside of that to get funded, you really do need to be a product of that ecosystem and build relationships with those support organizations to put yourself in the best position. So I just rattled off just a few early stage investors in the state of Arkansas. You can research these on your own. The Archangel Alliance actually came out of Fund for Arkansas's Future, the two funds that I managed for 15 years. So a group of those folks at the end of that second fund said, hey, we kind of would like to go back and try the syndicate model, where let's just put together a group of people who look at deals together. So that's what they did. That's called Archangel Alliance. The 412 Angels is funded by a partnership between, it's based in Northwest Arkansas. It's funded as in partnership between the Walton Family Foundation and the George Kaiser Foundation in Tulsa. They want to build that bridge between Northwest Arkansas and Tulsa. So they're super active. There's a VC firm called Atento, which is a couple of bullets down, that actually oversees the 412 Angel groups, but they're really active. They've done a great job of building membership. So these angel groups like that are probably the first step, those top two. Then you get into the venture capital firms. 46 VC has operations in both Tulsa and Northwest Arkansas. Atento Capital, Cadron Capital Partners, and the HeartX Fund, which we manage out of Health Tech Arkansas. We're all investing in the state of Arkansas. So those are just some of them. And I think I may, oh yeah, this is a diagram that I think sort of represents, and I pulled this straight out of the HeartX pitch deck, where we raise money for our fund. But I think it's hopefully helpful to you to see sort of the stages of how venture capital work. So innovations come out of, that R&D pre-seed stage, at the very earliest stage, when a company, to the extent there is one, is not profitable. It's just trying to get its research developed. So when you're in that startup R&D stage as an early stage investor, you can actually do really well, because the value of those startup companies, again, it's so low, right? So if I'm investing $100,000 in a company that's only valued at $1 million, there's a ton of upside for me as an investor. I can potentially make 40 or 50 times my money back. The challenge, though, is there's the highest risk, right? Because most companies don't come out of that early stage part of the pattern here. If you go all the way over to the market expansion stage, and let's say private equity firms like Stevens, for example, might invest $100 million in a company that's valued at $500 million. Well, that's a really well-developed company that's valued at $500 million. They've already got products in the marketplace. There's clearly way less risk investing in a company like that. The challenge there, though, of course, is there's not as much upside, right? If your company's already valued at $500 million, where are you going to go up from there? You're certainly, as an investor, you're not going to get a 10 or 20x return on your money at that point. So where we are, for example, with the HeartX Fund, is where Atento Capital is, and 46 VC. It's where I think the most fun part of the investing stage is. It's when companies come out of that startup and they're raising Series A rounds, for example, of $5 to $10 million, where their company's valued at $20 to $30 million. That is a fun place to be, because there's less risk than the early stage, but there's way more upside potential than there is for those later stage things. So that's hopefully will give you some context around the investing stages. So that is it. I think I must have not sent it, but I have one additional slide that I wanted to share with you, which was, so PitchBook is a big database company that tracks a lot of early stage investing activity. Just this past week, they came out with their 2022 numbers. And the state of Arkansas, we set a record last year in the state. So we had $202 million of venture capital invested in startups here inside the state, which was a record for us. Really shockingly for me, 94% of that was in Northwest Arkansas, which is just crazy to see the evolution. So we have gone from a state where there was really no venture capital to where we have got a pretty chunk. And for folks like me who've been doing this for 20 years, you know, we've sort of waited for the day when we can get big, significant investments like this. There was a company in Northwest Arkansas called Acre Trader, and they had a $60 million round last year. You know, that's a good chunk of it. So the state is doing some really good things, and we finally have meaningful amounts of venture capital being invested here in the state. So I think that is all I have. I don't know if we have time for questions or not. We do? Awesome. Happy to take any questions from anybody about early stage investing.
Thank you so much for this very valuable information.
Yes.
So obviously these companies, they are either focused in a particular niche or they're agnostic about type of technology they want to invest in.
Yeah, a good question. So if, and it depends on the source, right? So the HeartX Fund, we're a healthcare focused fund. So we invest only in healthcare companies, and specifically for out-of-state companies who come through our HeartX Accelerator program. Those are companies that are med tech, health tech focused in the cardiovascular space. So we have partnered with the state's 6 largest cardiology practices. And you know who they are. It's Arkansas Heart Hospital, St. Vincent, Baptist, Washington Regional, St. Bernard's, and Conway Regional. So those are generally the 6 largest cardiology practices. And so what we do is we bring these out-of-state companies in and we guarantee them pilot projects and clinical trials inside of health systems. We're actually the only program in the country that makes that guarantee. So we just get really fantastic quality of companies. So we're investing in the HeartX Fund in those out-of-state companies who come to do that. It's actually a huge benefit for us because we get to make very small investments, basically an angel size investment of $150,000 into venture capital stage companies. And the only reason we're able to do that is because these companies who are coming in that are well capitalized, they've got venture capital behind them. What they want are our hospitals. You know, they want the clinical engagement. They want the pilot projects and the clinical trials. And we say to them, well, one condition of our program is if we facilitate this clinical engagement for you, we've got this small investment fund over here on the side. We want to make an investment in your company. And they do that because otherwise $150,000 doesn't move the needle for them at their stage of development because they're not pure startups. So we also, though, invest in Arkansas-based healthcare startups across any clinical area, right? So we're agnostic, but it does need to be healthcare, medical related. Some of these other groups, or most of these other groups, will invest in any industry. Cadron, Atento, 46, all of them, they look at basically any industry. So, yeah. Other questions? Yes. Yes. Wow, that is great. So, so both 412 and Archangel Alliance are membership-based groups, meaning you just join them as a member and you get exposed to their programming. The models are different between those two groups, and it'll be interesting to me to see how this plays out over time. But the Archangel Alliance is a paid membership thing. So basically all their members get together and you pay an annual due and your annual dues. And what that gets you is exposure to all of their events, their programming, the deal flow. You're going to get to hear lots of pitches from startups. And so that those membership dues cover the overhead of the group, the Archangel Alliance administration, to do that work, right? So they are the ones that harvest the deal flow, vet and screen companies. They help organize investments when their members want to make investments. So that's sort of their model. And that's a very traditional angel group model. So 412, though, is taking a different approach because they're funded by the Walton Family Foundation and George Kaiser Foundation. They don't charge membership dues. And so it's free to join 412 as a member, and you get all the benefits. They actually do fantastic programming around what is an angel investor, how do you get started, what do you need to know, all of that. And it's all free to you as a member. But the downside to things being free is sometimes people don't perceive value in them. And so it'll be interesting to me to see over time, does Archangel Alliance get more traction because people actually have paid me membership dues and therefore they want to get their money's worth out of that? Or does 412 get more traction because they've just made it free for members? But essentially what the federal government says is, for you to be accredited as an angel investor and make investments in these early stage companies they're not regulated in the same way like public securities. If you buy shares of Microsoft, it's regulated and they have to file lots of securities documents to show you everything about Microsoft so you're fully informed. When you invest in a startup, they don't have to go through that same reporting requirements. So what the federal government says is, all right, we're only going to allow investments in startups by accredited investors. So by accredited means that you have to have household income of $200,000 individually, $300,000 with your spouse or partner, or have a net worth of $1 million. And if you meet one of those criteria, then the federal government says, you can take care of yourself, essentially. You're an accredited investor. You can make smart decisions, and we don't have to protect you as an investor like the same way if you're buying 10 shares of Microsoft, right? So anyway, that's the deal. That's how you become an angel investor. But it's a lot of fun. It's a high risk kind of thing. I tell people don't over allocate your portfolio into early stage investing because it is so high risk. But it's just a really neat thing to see all the startups that come through the state doing this kind of thing. So, good question, Sarah. Yes.
This may be too open-ended, but can you tell us a little bit about company valuation if you're before earnings and can get a
yes. Yeah, good, very, very good question. So, valuing a startup is way more subjective than valuing your house. If you're going to sell your house, you've got comparables of the homes in your neighborhood, et cetera. Valuing your startup company that you're essentially selling shares out of, so you have to put a value on that, is way more subjective. So nationally, over the past 10 years or so, I think the Angel Capital Association will tell you that the average valuation for a pre-revenue startup that gets angel funding from organized investment groups is about $2.5 million. But that's just a number. The range is probably 500,000 to 8 million, right? That's the actual range. And so where your startup falls on that range of somewhere between $500,000 to $8 million value is determined by a lot of different things, right? Which is, what's the quality of the science and the technology? How proprietary is it? What's the size of the market? Who's the team bringing this to market? What's the scalability? How big can it be? And, as an angel investor, your trick is trying to figure out all of that to filter that into what we think the value of your company is, because we know the entrepreneur is going to say, we think the value is here. We as angel investors think the value is here. So we've got to figure out a way to meet in the middle to make this investment work. So you just use your experience of looking at lots of companies over time to try to figure out what's the value. But if you said, what's an average ballpark, I would say, a couple $1 million is generally what we see tech startups starting out as a reasonable value to position themselves to be able to raise money. So, yeah. Yes, Mark.
So, in addition to capital,
yes,
go even with angel investments, you really are gaining partners.
You are. For better or worse, you're gaining a partner.
How much control are you giving up? Have to get through that.
Yeah. How
how painful is that relationship going to be going to?
Yeah, no, it's a good question. And again, it's one of those things, your mileage may vary, you know. So it depends on the investment group. Kevin's raised, early stage money. It just depends on the investment group, what your relationship with them, and ultimately what's the supply and demand of capital. You know, the more capital, the more you need that capital, and are in a position where I've got to take this and I'm probably going to accept some hard terms around that money, meaning I'm going to give up some rights as a founder to my investors. That's what it takes. The more you are in a position to not really need the money, where you've got multiple investment groups chasing you to be able to make an investment, then the less you obviously have to concede around those terms. But yeah, so in general, as you go along that, you remember the stage, the equity spectrum, in general, you're going to give up more of those rights as you go along the thing, because the sophisticated investors, the venture capital firms, the private equity firms, they're the ones who know how to extract those terms. Your rich aunt is not going to extract anything. The angel investment group knows a little bit, so we're going to extract a little bit more. So it just gets more onerous as you go along that spectrum in general. So, yes.
Follow up on that. Maybe it's a more advanced topic, but say you're a startup and you have the envious position, you have a lot of people interested in investing.
Yeah.
So you start shaving off, piece of your cap table. And start getting, getting percentages here and there. What's the balance? What's a good balance on that? How much of your company do you want to get? Do you want to trade?
Yeah, it's a good question. And cap table is one of those terms that Sarah cautioned us about to be at the very start. So a cap table, the capitalization table of your startup, is just your ownership roster. It's like, here are the people. Generally at the top of the cap table is the founder of the company. So you would own the largest percentage, but you may have given some to your brother-in-law because he gave you some social media marketing stuff, or who knows, But so your cap table starts to fill up the more you give away shares of your company. Your investors will obviously land on that cap table. So as you go along and you're populating your cap table, in general, the guidance is you want fewer people on your cap table as you can, because the more people you add, it just makes it more unwieldy. So in fact, venture capital firms, they want their startups that they invest in, when those companies that got an angel investment, they would far prefer that angel investment to come from an angel fund instead of 11 different individuals, right? Because it's just easier to navigate with that single investor. Every time a company does something that's meaningful in action, meaning it's going to open up a line of credit, it's going to do anything, it's going to sell more shares, anything meaningful generally has to get shareholder consent. So if you've got 37 shareholders, that's obviously harder to do than if you've got 6 shareholders, right? So you want to keep it as clean as possible as you go along, which means you need to put a lot of thought into the investors you do bring on board. What can they provide you beyond just writing a check? Sometimes as a startup, you just need the check. But if you're in a position to get more than the check and get strategic connections out of it, or relationships to customers, things like that, that's what you want to do, and just be as smart as you can. So, yes. Any other questions? Are we out of time, Sarah? Okay. Excellent. Well, thank you all for the opportunity. I'm going to hang around. I'm happy to chat with any of you after. Thanks.